You walk into the same bank, you use the same app, you sign the same terms and conditions. But depending on how much money you have sitting in that account, you are living in an entirely different banking universe, not a slightly better one, not a marginally upgraded one, a completely parallel system with different rules, different people, different products, and a different relationship with money itself. Today, we are going to walk through every level, from the person with nothing to the person with 25 million. And by the end of this video, you are going to understand something that banks spend enormous amounts of money making sure you never figure out. Let us start at the bottom. $0 to $1,000. This is where the bank is not your friend. This is where the bank is your landlord and you are behind on rent. At this level, you pay for the privilege of having an account. Monthly maintenance fees, minimum balance fees, overdraft fees that can reach $35 per transaction. The average American pays $250 per year in banking fees. People in this bracket pay the most, not the least, the most. Here is the cruel mathematics of being poor at a bank. You have $200 in your account. You forget about a $12 subscription. The bank processes it. You go to negative $12. The bank charges you a $35 overdraft fee. You now owe $47 on a $12 purchase. You deposit money to cover it, but the bank processes other transactions first in an order designed to maximize overdraft fees. This is called transaction reordering. It is legal. Wells Fargo paid $1.7 billion in settlements related to it, and then kept doing it. At $0 to $1,000, the bank sees you as a cost center. You generate fees. You consume customer service. You are, in the coldest analysis, a liability they would prefer to manage rather than serve. $10,000. This is where the penalties start to soften. You qualify for a free checking account at most major banks. The overdraft fees still exist, but you are less likely to trigger them. You have access to a debit card, a savings account paying somewhere between 0.01 and 0.5% interest, while the bank lends your money at 7, 10, or 15%. At this level, you are a basic customer. You get the call center. You get the automated phone system. You get 45 minutes on hold. When something goes wrong, a fraudulent charge, a disputed transaction, a hold on your account, you prove your innocence. The bank does not assume good faith. You do the paperwork. You wait for the decision. Your credit at this level is treated as a risk. If you need a personal loan, you pay 12 to 24% interest. If you use a credit card, the average APR is now above 20%. The bank is charging you the highest possible rate because it has decided you are the highest possible risk, not because you have defaulted, not because you have missed payments, simply because your balance is modest, and modest balances are statistically correlated with default in a model that was built by someone who never had a modest balance. Now we move into the territory the bank actually wants you in. $10,000 to $100,000. You are what the industry calls mass affluent. You are profitable. You are worth keeping. At this level, the fees quietly disappear. You get a dedicated banker, or at least someone who answers the phone by the third ring. You get access to high-yield savings accounts. You get preferential credit card rates. You start receiving relationship pricing, which is the bank's way of telling you that it values you enough to stop penalizing you for existing. But here is what is interesting about this level. The bank is still making far more money from you than it is giving back. Your $100,000 in savings is earning you 2%. The bank is deploying it at 6, 7, and 8%. The spread, the difference between what you earn and what they make, is their margin. And at this level, that margin is enormous. You are the bank's favorite customer, not because you are wealthy enough to negotiate, but because you are wealthy enough to be profitable and not wealthy enough to know it. $100,000 to $1 million. This is where the relationship changes. This is where the bank starts coming to you. You get a personal banker with a direct number, not the call center number, a real number that rings a real person who knows your name. You get access to wealth management consultations. You get invited to exclusive events, seminars, market outlooks, client dinners. The bank is no longer processing your transactions. The bank is managing your relationship. At this level, you get access to products that are not advertised publicly. Preferred mortgage rates, pre-approved credit lines at prime plus 1%, private client checking with no fees, no minimums, and fee-free wire transfers. You get currency exchange at institutional rates rather than tourist rates. These benefits are worth thousands of dollars per year. They are never listed on the bank's website. You only discover them if a banker tells you, and a banker only tells you if you are in this bracket. The irony is sharp. The people who need fee relief the most get the least. The people who need it the least get everything waived and more. $1 million. This is the door to a completely different building. Private banking is not an upgrade of retail banking. It is a separate service, staffed by different people, operating under different economics. Your private banker is not someone who manages 300 accounts. They manage 20. They know your children's names. They know your business. They know when your mortgage renews, and they call you before it does. At this level, you get access to alternative investments. Private equity funds with minimum investments of $250,000. Hedge funds, structured products, things that were not available to you at any previous level, not because they are secret, but because the minimums were designed to exclude everyone below this threshold. Your loans at this level work differently. You can borrow against your investment portfolio at 2 to 3%, the same buy, borrow, die strategy that billionaires use, available now to mere millionaires. You never have to sell an asset. You never trigger a capital gains event. You live on the loan. It is one of the most powerful legal tax strategies in existence, and your private banker will walk you through it over lunch. The fees you pay at this level are percentage-based, typically 1% of assets under management per year. On $5 million, that is $50,000 per year, which sounds like a lot, until you compare it to the tax savings, the preferential borrowing, and the access to returns that are simply unavailable at lower levels. The math, for the first time, starts working in your favor. 5 million to 25 million. This is where the bank stops being a bank and starts being a service. At this level, you do not have a banker. You have a team, a relationship manager, a dedicated investment advisor, a tax specialist, a credit specialist, a concierge service. The bank has calculated precisely how much revenue your assets generate, and it has staffed your account accordingly. Your mortgage does not go through an underwriting department. Your relationship manager calls the credit committee directly. Your loan is approved in 48 hours based on your relationship, not your credit score. Your credit score is largely irrelevant at this level. The bank knows exactly what you own. They hold most of it. The risk calculation is theirs, and it runs in your favor. You get access to IPO allocations. When a hot company goes public, the retail investor waits for the opening bell and buys at the inflated first-day price. You get an allocation at the offering price the night before, at a price that is sometimes 30, 40, or 50% lower than what the public pays. This single benefit, compounded over years, is worth more than everything the bank has ever charged a customer in the first bracket. Your currency exchange happens at interbank rates. The spread is 0.05% rather than 3%. On large transactions, this alone saves tens of thousands of dollars per year. These are not perks. These are structural advantages that compound over time into a permanently widening gap between you and everyone below you. Now step back and look at the entire picture. The same institution, the same logo, the same building on the corner, but 5 entirely different businesses running inside it, each calibrated to extract maximum value from customers who cannot negotiate and deliver maximum value to customers who can leave. The person at 0 to 1,000 is profitable through fees. The person at 1,000 to 100,000 is profitable through the spread between what they earn and what the bank makes. The person at 100,000 to 1 million is profitable through wealth management margins. The person above 1 million is kept, not for the fees, but for the assets, the relationships, and the referrals. This is not an accident. Every tier of banking was designed by people who understood exactly which customers had leverage and which ones did not. The overdraft fee was not an oversight. The preferential IPO allocation was not a favor. Both are deliberate architecture. The question is simply which side of the architecture you are standing on. There is a reason banks do not publish a comparison chart of what each level of wealth gets you. There is a reason the private banking brochure is not in the lobby next to the free lollipops. The system works because most people never see the whole. You have just seen it whole. Every level, every fee, every benefit, every structural advantage compounds quietly over decades, while the person below it pays for the privilege of having less. Subscribe, because this channel exists to show you the architecture of money so you can decide, with open eyes, which side of it you want to build your life on.